The US just shot down 20 drug boats and took over 80 suspects. Now, war rumors with Venezuela are flying, and this could send oil prices skyrocketing. I am Sophia, and I'll show you how to get ahead of these headlines and spot real profit opportunities by reading oil data. Before we dive in, make sure you hit that subscribe button so you don't miss any important market update. When we're talking about geopolitical pressure building, oil supplier stocks move first, and Exxon and Chevron are at the center of it. Actually, the recent performance is being driven by geopolitics instead of traditional company fundamentals. They're not dependent on Venezuela, they're really diversified, they're global and positioned to sell barrels the moment the market gets desperate. This isn't speculation, we've seen this movie before actually. When the US sanctioned Iraq in 1990, oil prices nearly doubled because overnight the world lost access to one of its biggest suppliers. But the oil market didn't actually crash because of what? Exxon, Chevron, EOG stepping in to fill that void and profit from scarcity. Oops. And actually, that's just phase one, because supply disruption is only the beginning. Traders actually care about supply. The market panics about tomorrow, not today. Inventory figures come from two key reports, and you have to remember these because one number comes from the API, the American Petroleum Institute, and the other one comes from the EIA, Energy Information Administration. Inventory reports tell traders how much oil is available right now and how nervous they should be about tomorrow. I want you to picture this. I want you to think of the API and the EIA like two friends texting you about some party. If both say it's packed, everyone plans to go, right? If one of them says it's dead, then your plans, they change. We've all been there. Like, the party looks dead and the bouncer says no one else is gonna get in. That's the inventories falling while supply gets threatened. Everybody starts grabbing whatever's left, and the oil market, that means that traders rush to buy because scarcity creates panic. Now, currently, according to the API, we are about 4% below the 5-year average. 4% below is not that bad. It may not sound that dramatic, but it's really bad. In oil markets, anything under the average during geopolitical tensions is explosive. It's a bomb for the losers because there's going to be so many losers, and those are airlines and shipping companies like Delta, American Airlines, FedEx, UPS, cruise lines, and all of those consumers in the United States like you and I. Their fuel becomes more expensive. The cost, of course, they rise and triple for the entire economy. Now we have like refiners like Valero, Marathon, and Phillips 66. They might get squeezed as well. These companies, they buy crude oil and turn it into gas. And the gas that you use for your car, the jet fuel in the planes you fly, the refiners pay more long before you do actually, and that squeezes their profits. So how do traders place bets before the headlines confirm anything? Oil futures. Oil futures. Reading futures is easier than it sounds. As you might know, futures contracts show what the market expects to happen next on specific commodities. For oil, traders watch the key price metrics for crude markets on platforms like TradingView, CME Group, and MarketWatch, etc. You can start with WTI futures, West Texas Intermediate. They reflect what's happening with the US oil market. This crude mostly comes from Texas and nearby states, and its price moves based on American supply and demand. Then we have the one and only, the Brent. This is the global benchmark. This is oil from the North Sea that travels by ship to many countries. Its price reacts more to wars. What are we having? Possible wars, and actually current wars, sanctions, and global disruptions, especially in places like the Middle East. The US has imposed actually new sanctions targeting Russia's energy sectors, blocking certain large producers, shipping insurance firms. In reaction, hedge funds have reduced bearish bets. What are those? They're the short positions on oil. They don't expect oil to crash anymore, especially Brent crude, because the sanctions raised the possibility of tighter supply and higher prices. According to Bloomberg, actually, some fund managers who had expected to lower oil prices due to weak demand or other factors are now, guess what, anticipating where this Venezuela story goes next. For regular investors, what does this mean for you or for me? One way to get exposure to Brent prices is the ETF BNO. It tracks the price of Brent crude. I am not telling you to gamble your rent money, hello, like a finance bureau with 5 monitors and 0 sleep. No, this is just one angle because markets can change, but I'll keep you on the loop and see you next time.